So today we'll continue our discussion on the project-specific cost of capital. Project-specific costs of capital. So when we talk about cost of capital, we've laid the foundation over time that cost of capital, this has to do with sacrifice that organizations have to make to ensure that investors get their money as expected. So cost of capital, we said, represents the compensation required by the suppliers of funds from their investments. And we said it is a return that suppliers of capital, and who are the suppliers of capital? They include bondholders, shareholders, or owners of a business, as the equity holders. The return they require in form of compensation for giving out their resources in form of capital to the business. So it is the minimum rate of return a company must earn in order to retain its value. So we lay this background over time on cost of capital, and we've looked at various ways we can compute costs of capital. We said there are various forms of capital. We have equity, we have loan notes, otherwise debentures, we have preference shares, and the rest of it. So each of these have costs associated with them, and there are various ways we compute them. So, and we in the last class, we looked at a way where we can look at the ratios, the weight of each of these capital put together in terms of the overall capital structure of the organization, which is WACC, which is termed as weighted average cost of capital. So we've looked at one or two examples in which I still encourage us to get questions to solve and be very good on that. Yes, there are some questions in the practice kits in which I put together, and you can also have access to the question, this question that was flying around after the exams, in which some persons said question 1 was picked from it. Yes, there is a question in which somebody solved and shared with me in that booklet. If you don't have it, I'll still look for it and forward it also. Yes, the more you practice, the more you get exposed. So in that last class, we briefly talked about project-specific cost of capital, which I said we'll solve questions on it today. And in that class, we showed various steps required to solve project-specific cost of capital. So we said the reason for project-specific cost of capital is that an organization might want to diversify, or an organization capital structure can change. So where an organization wants to diversify into another form of business, there is a need to understudy the new sector in which the business wants to diversify into. And what is the main concern of that study is to look at the business risk, is to evaluate the business risk. If company A wants to diversify from confectionery making to yogurt, you will have to consider what are the business risks associated with yogurt. Yes, it's very important. Though you don't have any business with the financial risks, because financial issues are peculiar to individual organizations. So my capital structure might varies from yours. So what is common to company A and B will be the business risk that is associated in that particular industry or sector. So financial risk is peculiar to individual businesses. It is not a common factor. to organizations in a particular line of business. So a project-specific cost of capital is a discount rate adjusted to reflect the risk of a particular investment project. So rather than using the company's existing overall cost of capital, we need to readjust and bring in the business risks of the new venture, the new industry or sector we want to venture in, into our own business and see how the WACC will be adjusted and see how it will affect the WACC of our business. So in that class, we said a measure of business risk is, we use beta, that beta is a measure of risk. And we said there are basically two types of beta, and we said we have asset beta and equity beta. And we said asset beta is used to measure risk associated with the industry in which a company operates. That is asset beta. While equity beta is a measure of business and financial risk. Please, I want you to follow at this point now. Asset beta is a measure of the risk associated with a particular industry. Take note of that. Take note of that. So you can see from my screen, you can see this. This is asset beta. This, where my cursor is asset beta. Take note of that. For equity beta measures both business and financial risk. So when you're trying to solve question on project-specific cost of capital, on diversification, now, one thing the question will put forth, as you read through the question, you see another company different from yours. That company is termed as what? The proxy company, the company to be understudied. So once you identify that company, you look at their business risks. Your major concern regarding the proxy company is their business risks. So most times you will be giving equity beta. Take note. I just said equity beta consists of what?
Please, your screen is not showing your screen.
Please, can anybody confirm this, please?
It's a network. I've logged that.
Yes,
No,
sir. Good evening.
the screen shows. I think you need to just move past all the participants. Just scroll up in case you have a full screen. That's the lady who just complained. The lady who complained. So your
It
screen is
happened
visible.
to me
Please.
also.
All right, thank you, sir.
The
Yes, sir.
screen is visible, but we cannot see the particular area you are explaining, sir.
No, I'm not moving. Oh. I'm still on
Okay,
this
sir.
particular slide.
Okay,
Just,
sir.
I want you to follow keenly what I'm saying. Yes,
Okay.
yes, I'm still bringing out the bed from my pockets. Yes.
Okay, sir.
So,
Thank you.
yes, let me borrow that Yoruba adage. Yes. So, now I said that asset beta. Please follow very well, because
Because of measures.
yes, asset beta measures risk associated with the industry in which a company operates. Now, when you identify a proxy company in a question, most time the question will give you what? We give you what? The equity beta of the proxy company. And what is equity beta? I just explained that equity beta is a measure of business and financial risk. Is a measure of business and financial risk. Now, if you identify the equity beta of a proxy company and what you are concerned in that proxy company is just the business risk, what will you do? What will you do? What you will do is to separate, is to remove the element of financial risk, is to identify the business risk. And how will you identify the business risk? Is to ungear. Take notes. Look at this step. Step 1, identify what? The proxy company. Now, when you identify the proxy company, if you have the equity beta in the question, what will you do?
You ungear.
You ungear. Because why are you ungearing? You must know why you are ungearing. Very important. Because the equity beta contains what? 2 things. What are those things?
Business and financial.
Yes, contain business and financial risk. So what is your concern about the proxy company? Is the business risk. Is the business risk. Hence, the need for this formula here. You can see this formula. For you to get your business risk, and we said business risk is what? Asset beta. This sign here is asset beta. You want to get asset beta. And in the question you are giving what? Equity beta. What will you do? You use this formula here. You use this formula. Now, in most questions, you might not be given the debt beta of the proxy company. That is, this is debt beta. This item here, this is debt beta. Where you are not given the debt beta, it means debt beta will be 0. So debt beta multiplied by this aspect of this formula, everything will be what? 0. So most times you will see this as the only option to use. When you check every of your question paper, even when you check PM question paper, you see this formula there. You check financial management question paper, you see it. You see these formulas there. But to me, I prefer you absorbing the formula to yourself. Let it be with you. Don't always think you will see it it will always be there. But I just want it to, by the time you keep solving and solving, it will be part of you that you don't actually even need to look at anywhere. So, but one thing I must emphasize is that as you study, you see different expressions of this formula. Don't get confused. Know the appropriate formula to use. No matter how they change it, your result will still be the same. That is one thing with this, because by the time you begin to carry one textbook to one another, you see different ways of writing it. So at that point, students often get confused and frustrated because they feel like, what is this? What is this? You understand? But the point is, stick to a particular one and always know the variables to use, and you'll be fine. Because when you go to 3 different textbooks, you see different approach of writing all this. So take note of that, so that when you see another one, you don't say, this one is wrong. They are all correct. They are driving towards the same destination. So once you are giving assets equity beta in a question, and you have to determine the asset beta, you use this formula. Now, when you ungear, another thing is, in some literatures, instead of ungear, they will say degear. It's still the same story.
Okay, yes.
Still the same story. So once you ungear the proxy company to get, and why are we saying ungear? This gear means we're trying to remove the debt element of the proxy company, because gear means there is element of debt. So we're trying to remove the financial element in the risk to get just the business risk. So once you identify the asset beta, you now regear. How do you regear? You regear by incorporating the debt element of the existing company. That is, you borrow this business risk here that you've derived and incorporate it into this formula here. Now you want to get the equity beta of your own company. Now the equity beta in regearing will be what? Asset beta multiplied by what? Into the bracket of 1 plus the debt proportion all over the equity proportion of your own organization. That is regear. This formula have different ways also of expressing it. Yes, there are different ways of expressing it. I've decided to use this to express this way. So if you use another approach, you still get same results. So you regear. How do you regear? You use this formula. And as you regear, you get the equity beta. And this equity beta consists of what? What? Hello? The equity beta consists of what?
Both business and financial risk.
Financial risk and business risk.
Yes, it contains now, this equity beta contains the business risks of the new sector we want to venture into and our own what? Financial risk, our own financial structure. Our own financial structure. So this is it. This is it. So now, once you get the equity beta, after incorporating the business risks of the new sector into your own venture, what do you do next? You determine the cost of equity. You determine what? The cost of equity by using what we call CAPM. CAPM is capital asset pricing model. Is a topic on its own, though it's one of the way we use to determine cost of equity. If you reflect back while we're discussing cost of equity, after using dividend valuation, another method is the use of CAPM. So to determine the cost of equity, you use CAPM. And CAPM formula is what? Cost of equity equal to risk-free plus what? Plus equity beta into the bracket of what? Market premium. Where these two are not given, you can just be giving market premium. But where they are given individually, this is market return less risk-free. And by incorporating the various variables, you get your cost of equity. Now, once you get your cost of equity, what do? You estimate your WACC. The cost of equity here will be used to estimate your WACC, the new WACC of your own business, So this is just a simple steps, just to reiterate what we discussed in the last class. So now I forwarded a question to the group. Though there is this other question I showed us last week that we're going to look at. We have more questions I want us to look at. So I forwarded this question to the group this morning. Can somebody read? Let's analyze this. I want to use this to analyze first. Yes.
Sorry,
this
Mr.
is
Sofer. Sorry, I'm sorry, sir, please. Good evening, sir. Please just go back to that formula. I need to just get a word from there. Sorry, sir. I'm so sorry for taking you back.
no problem.
Thank you.
So if you have the question in your, if you have access to the
I'm
question
done,
on
sir.
the WhatsApp, you can read.
I'm done, sir.
All right, thank you. If you have access to the question, you can read. Though it's not that clear here, but it's on the WhatsApp group. You can just make reference to it and read. Yes, I need somebody to read it out. Madam Chioma, please read. Except all of you are in the kitchen.
Okay, I read. Zedimo Co. is a listed company in the house construction industry. Results have been disappointing, and as a result, the share price has fallen from a high of $3.50 per share 5 years ago to only $1.05 per share today. This deterioration in the performance and share price has been accompanied by an increase gearing to a high level. Zedimo Co. capital structure is as follows: million in dollar equity, share capital in brackets 50 kobo per dollar per share, nominal value $40 million, retained earnings $35 million, long-term liabilities 6.5% irredeemable loan notes in bracket $100 per loan note, nominal value $250 million, 7% bank loan $20 million. Zedimo Co loan notes are quoted as $65 per loan note, and both the loan notes and the bank loan are secured. Zedimo Co's equity beta is 2.3. New venture to improve performance. Zedimo Co is considering the
No, I think she's logged out. Can somebody pick it up from there? Is there anybody in this class? Can somebody pick it up from there?
Hello, can you hear me? Good evening once
Yes.
again.
I can hear you.
So, from New Venture, to improve performance, Zedimo Co is considering the construction of commercial property such as office blocks and industrial complex. This is a new activity for Zedimo Co, and it is expected that the risks involved will be different from its current activity. The financial director has proposed that a project-specific discount rate should be used to appraise the new venture. But, but the commercial director does not believe this is necessary. Wiston Commercial Properties Co. WCP undertakes commercial construction projects similar to those being considered by Zedimo Co. WCP has an equity beta of 1.25. WCP has $10 million of ordinary shares in issue, currently quoted at $2.60 per $1 nominal value ordinary share. The company also has $110 million of loan notes in issue, currently quoted at $96 per $100 nominal value. Both companies pay tax at 20%, the risk-free rate is 4%, and the expected return on the market portfolio is 10%. AI. Using the capital assets pricing model, calculates Zedimo Co current cost of equity and a project-specific cost of equity stable for the new AI. Using the capital assets pricing, sorry, I'm repeating it. And 2, referring to your calculation above, Comment briefly on the view of the commercial director. B. Discuss 3 problems Zidimore Co. may be facing as a result of its current high level of gearing. C. In respect of both equity and debt, discuss the risk-return relationship and how it affects Zidimore Co.'s financial costing.
All right, thank you very much, Ma. So looking at this question, we have Zedmo Co. as a company, but they are looking at a new venture, and there is an existing business, an existing organization in that new venture, and which is what? Winston Commercial Properties. So what they do is that they undertake commercial construction projects similar to those being considered by Zidmore. Yes. So it means that the proxy company here will be which company? The proxy.
Winston Commercial. GWP, Winston Commercial.
Yes, Winston Commercial Properties. Yes. And we have various information given. For Zidmore, we have their capital structure given, equity, we have share capital. Now, the nominal value of one share capital under Zidmore is what? It's 50 cents. 50 cents per share, nominal value. See it in bracket, you know. Anytime you say anything in bracket, take notes. It's not just put in bracket like that. There is a reason for it. The retained earnings is what? 35 million. The long-term liabilities, we have 6.5 irredeemable loan notes. That is one loan note costs how much? You can see it's clearly stated. You know, we said debt is valued at 100 nominal value, 100 naira, $100 nominal value, except otherwise stated. So $100 per loan note nominal value. You can see that. And we have 7% bank loan. 7% bank loan. So the question is, I'm mostly concerned about the A part, though we can still discuss other parts likewise. The A part, using the capital asset pricing model, calculate Zidmore Co.'s current cost of capital. The interpretation of this question, before looking at the new venture, what is Zidmore Co.'s current cost of equity? Current cost of equity based on the data given. Using what? CAPM. And the formula for CAPM is what? As we've seen, is what? The formula for CAPM is what? This is the formula for CAPM. This is it. Because KE is what? Cost of what? Equity. The question is telling you to do what? For A, the question is telling you to do what? That you should calculate Zedmore Co.'s current cost of equity. So based on the information you have in the question, can you tell me the risk-free rate associated with Zedmore Co.'s company from the question? You know, I forwarded this question not just for decoration, or not because I was extremely busy when I forwarded the question. Yes, but because I don't want to come to class and you just be seeing the question for the first time. So it is expected that you read through. It's not just that it's just there. It's not just there. So based on the information you have, can you tell me what's RF, the value of RF from the question?
4%. 4%.
Okay, 4%. If you go to the Second to the last paragraph in the question, you see it. Both companies pay tax at what? 20%. The risk-free rate is what? 4%. And the expected return on the market portfolio is what? It's 10%. 10%. So based on the question, using capital asset pricing model, calculate Zedmoco's current cost of equity. RF is what? 4%. Now, what will be your equity beta? Check the question. It's also there, given free of charge.
It's 2.3.
2.3. 2.5. It's given free of charge. 2.3. Now, if you have your equity beta given, what is your market return?
10%.
Yes, the expected return on the market portfolio is what? 10%. 10%. And your risk-free is still what? 4%. So based on this, can we compute the cost of equity, the current cost of equity of Zedmoco? All the variables, the figures we are talking about, they are all in the question. So we can have it. Let me just use this slide. Let's say solution. Solution. Current cost of equity. Current cost of equity. That is KE. Current cost of equity. So based on the information we have cost of equity will be what? Your risk-free rate in the question is what? It's 4%. 4% plus what? Your equity beta as given in the question. Immediately under that table, you see it. Zedmoco's loan notes are quoted at $65 per loan note, and both the loan note and the bank loans are secured. Zedmoco's equity beta is 2.3. So that is the equity beta, 2.3. Now, what is your market return? It's given in the question as return on the market portfolio is what? Is 10%. 10% minus your risk-free. Your risk-free is what? Is 4%. So when you do plus and minus, what will be your costs of equity using Kaplan? Your cost of equity will be what? Yes, punch your calculator. I need your response.
17.8.
17.8. Who else is not getting 17.8? Or who else is getting 17.8? Why I'm asking you to give me the result is that to learn how to press calculator is one thing, and to learn how to do your computation is another thing. Because you can be, okay, fine, 17.8. Thank you, sir. On the chat box, 17.8. Yes, it's 17.8%. So this is just one aspect. So when trying to solve question, you must read very well what the question entails. Now, we've treated part of A1, that using the capital asset pricing model, calculate Zedmoco's current cost of equity and a project-specific cost of equity. A project specific cost of equity suitable for the new venture. So let's take it further now. Let's take it further. So for project specific cost of equity, what are we going to do? For project specific cost of equity, what are we going to do now? So we have it, project specific cost of equity. Project specific cost of equity. So what are we going to do? Can I get contribution before I go ahead? It's very important. You know, I'm not the one writing the exams, so I need to get your contribution.
We will first identify the.
I'm not still seeing the screen since morning. I'm not seeing the screen. No. I don't know what is wrong. I've been going out, coming in since. I'm not seeing the screen since we started.
Do you have another device? So you join with that other device if you have
My
another
laptop
device.
is not charged. I've not charged my laptop, so I'm managing the phone.
Yes, because it might be a network. If others can see it, but either you have another phone, another device around you, you can just send the link to it, then you connect. Definitely you'll see it. Definitely.
Thank you, sir.
Sorry about that, man. So, yes, you were saying
Okay,
something, sir.
so we'll first, going by the steps, I think the first thing to do is to identify the equity beta of the project company, which is Winton Commercial Properties. I think it were given 1.25 as their equity beta.
Okay. Okay. 1.25 as their equity beta. Very good. Yes. 1.25 as the equity beta. Yes. So let us put down this as we solve. Now, just as you have said, identify the proxy. The proxy. And the proxy is what? In short form, WCP. To derive what? What do we need them for? To derive a suitable and Z more equals beta is not suitable. Is not suitable for the new venture. For the new venture. Why is it not suitable? Due to different risk. Due to different risk. Due to different risks. So, since we've identified the proxy company and their beta, the equity beta of that proxy company is what? According to the question, the equity beta is what? Equity beta of
1.25.
proxy company is, you said is what, sir?
1.25.
1.25.
1.25.
Okay, fine. Now, having identified the proxy beta, what will you do next? What will you do next?
We check if the company is JED or unJED.
Okay, fine. So the proxy company, based on the financial data of the proxy company, is there any element of debt?
Yes, sir.
So it shows that they are geared. They are geared. So what are we now going to do? We're going to ungear. We're going to do what? We're going to ungear. Ungear what? The proxy beta. Ungear the proxy beta. And for us to ungear the proxy beta, we're going to use a formula. But before then, yes, let's go with the formula. Ungear the proxy beta. To ungear the proxy beta, there is a formula. And what is the formula? We need to come up with. To ungear, we need this. We need this. We need this. Multiply by what? The proportion of equity divided by what? The proportion of equity plus debt, net of tax. Net of tax. Now, from the question, there are certain things I still want us to note from the question. What is the market value of equity of the proxy company? Market value of equity
2.60.
of proxy.
2.60.
Okay, fine. 2.60. So that's 2.60 is just for one, right? It's just for one.
Yes,
For one
yes.
equity. For one equity. Please follow the question. It's very important, even though I might not be going back to the question. If you check the question, the market value of 2.60 is just for one. It's just for one equity. The question is, for Winston, how many shares, or what is the value of their shares? On the question, the value of their shares for Winston.
100 million.
All right, 100 million. Somebody is looking for it, I know. Go to the third paragraph before the question. You see, Winston Commercial Properties Company undertakes commercial construction projects similar to those being considered by ZMOCO. So Winston
Hello. Is anyone here?
Ordinary share in issue. How many shares do you have in it? In that 100 million, how many shares? How many ordinary shares do you have in it? I want that understanding to rest with us. How many ordinary shares do you have in it?
100 million, sir. Because of the
That 100 million is $100 million. How many shares do you have in $100 million? 100 million, right?
Yes, I think we will divide it by the nominal value of $1.
Okay, fine, of $1. Very good. So you still have how many shares? 100 million. 100 million. 100 million. So that 100 million multiplied by the current market value of one share will give you what?
$2,600,000.
Fine. Let me show it. Let me show the workings. So we have it. Though I'll just write the millions in short form. So market value of equity of proxy, we have it as what? Equal to 100 million. 100 million multiplied by what? 2.60. Multiplied by 2.60. And this will give us what? This will give us what? 260.
2,600,000. 2,600,000.
2,600,000. So if you multiply this by 1 million, you should have that. I'm removing the millions. It should be 260 million. I don't know if you are correct.
Yes, it's 260 million.
Yes, 260 million. If you are working, if you want to use the whole value, if you want to add the other millions to it, but I don't want to write too much. So this is the market value of equity of the proxy company. The market value of debt will be what? Market value of debt of the proxy company. Market value of debt of the proxy will be what? From the question. When you go to the question,
105.6.
105.6. Okay, that is the result. Okay, fine. 105.6. Yes. But how do we get 105.6? Now, when you look at the question, the company also has what? 110 million loan notes in issue. 110 million loan notes in issue. Currently quoted at what? $96 per $100 nominal value. So the question now is, how many loan notes, how many structures do we have in $110 million? How many loan notes do we have in it? You know, you can solve it in different ways. So in case you want to solve it in that way, how many loan notes do you have in $110 million? It will be $110 million divided by what? 100.
100.
That is the nominal value to give you the number of loan notes in 110 million. So that result multiplied by what? By 96. We give you what? We give you 105.6 million. But you can also do it this way by saying that what? By saying that 96. Let me see. 96 divided by 100 will give me what? 0.96. multiplied by 110 million will give us what? 105.6 million. 105.6 million. I don't know if this part is clear, but let me just show it. This is what we are saying. That if one loan note, let me just put it this way. So it will be like this: 110 million multiplied by what? 96 divided by 100. When you do it, to give you the market value of the debt as at today. So instead of placing this 100 here, you can also place it under 110 and multiply the result by what? By 96. You get same results, because somebody will be asking, why are we putting 100 here? The nominal value of the debt is what? The nominal value of the debt is what?
100.
Is in the question. So to know the market value, you need to divide this 110 by 100 to know how many loan notes is in it, multiply by the existing market value of 96 to give you the overall market value. And that will be what? 105 point what? 0.6 million. 105.6 million. So with these data now, can we substitute into this formula? With this information, can we substitute into this formula? Yes, I need a response. Now, the tax rate is what? Is given in the question. The tax rate is what?
20%. 20%.
Fine, 20%. So with the information you have on this screen, can you substitute into this formula? You know, we are looking for asset beta. We have equity beta as 1.25, right? Our market value is what? Of equity is what?
It's 260 million.
260 million. Divide by market value of equity again, 260 million plus what is D? Market value of debt.
105 million. 105.6 million.
So net of tax. So I want everybody write it out before I put it on my own screen. Substitute into this formula and punch your calculator. Give me the results. Substitute. I need the results. What is the value of asset beta? Madam Chikodili, hope you are at home now.
I follow from beginning now, just that my network is bad.
Well, I hope it's stable now.
Yes, sir.
So I need the answer to this. Wow, I should be getting answers by now. You know, I need to monitor how fast you can be. Not by just me solving. So that is why I want you to try and do something.
Honestly, to me, I'm just following you for now, sir. I'm very glad.
Okay, that's no
I'm in that condition for now, sir.
Okay, you have to leave. We have to leave that condition. Though. It's not good.
Honestly.
Anyway,
I
I
missed,
understand, sir.
I missed the foundation when I went to pray.
Okay, wow. Sorry
So
about that.
the 7 o'clock prayer, that is where I missed the foundation.
Okay, okay. All right. Okay, no problem. When you watch the video, you can reach out when you have issues. All right. I can see a response from the chat box. Okay. Asset beta is 1 point. Let me see again. 1.27. Okay. Can I get a confirmation?
So I got 1 point.
1
I don't
point.
know.
No, you have to know. 1.28. Okay. Okay. That is serious.
I got 1.5.
1.5. Okay. Wow.
1.5. 1.5.
1.5. Okay. Okay. 1.5. 1.5. Wow. 1.5. 1.5. Okay. I need somebody to tell me what have you done? Can you give an explanation of what you've done that you arriving at that answer?
Okay. My equity beta is 2.3 multiplied by the equity, which is 260.
Sorry, let me cut you short. You know, you are still working based on the proxy.
Okay.
Your equity beta should be 1.25.
Okay.
See, on gear the proxy beta. This is the proxy beta. And the proxy beta, you are giving equity beta 1.25.
Okay. Thank you, sir. Thank you.
Yes, because I'm not still getting the result I want. That is why I just need an explanation to know what is happening.
Sir, I got 0.944. I'm not sure whether it's correct.
Very beautiful.
94, 0.94.
That is the answer I want.
What did I
0.94.
got to?
0.94.
0.9447.
Yeah. 1.25 multiplied by 260 all over 260 plus 105.6 in bracket 1 minus 0.2.
Yeah, multiplied by 0.8.
So that is the result I want to get.
Oh,
So everybody has.
I think, hello, sir.
Yes, ma'am.
If you check the formula is equity plus debt instead of a multiplication sign. I think that's where we made mistake because I'm using addition sign instead of multiplication.
It's multiplication that is there. I have multiplied it.
So let me show it now. And I'm checking at what point is the multiplication? I want to know.
I think, I don't know, but I think where I made mistake is
So you work on it again. 1.25.
instead of equity,
1.25. This is 260, right? That is market value of equity. Divide by 260. The debt value is what? 105.6. The tax element is what? 20%, 0.2. So once you simplify this, your result will be what? Your asset beta will now be what? So your asset beta will be 0.94, just as they've said. 0.94. If you know you are punching your calculator and you're not getting it, just raise your hand. Just any question before we take it further?
I'm not getting it, sir.
Please, I'm not getting the 0.94.
Okay, fine. 1 minus 0.2 is what? You follow board mass. 1 minus 0.2 is what?
0.8.
Multiply by 105.6. You have what?
84.48.
84.8.
Plus 260.
Okay.
344.48.
84.8.
So 260 divided by 344.48.
0.75476.
Multiply by 1.25.
0.94.
Now, Peter did get this class today.
I'm just returning from New Year celebration.
Oh, welcome back.
Mr. Todd, I have a question now.
All right, sir. What is the question, sir? Welcome
Thank
back,
you,
sir.
sir.
Yeah,
Thank you, sir.
Yeah. Okay. That's on gear. I thought we will add beta debt multiplied by debt 1 minus t bracket all over equity plus debt bracket 1 minus t.
Yes, that is where it is given.
Okay, yeah.
That's why I said where it is not given, it will be 0 multiplied by that aspect of the equation.
Okay.
And 0 multiplied by everything on that side
Yes.
is 0.
It's okay. I remember now. It's okay.
So, having derived your asset beta, what will be the next step? What will be the next step?
To regear.
So, we are regearing based on what? Is it based on the proxy company or based on our own
Based on the existing.
based on our own company now?
Based on the existing company.
Based on the existing company.
Our own company.
So what are you incorporating into the existing company?
Debt elements.
Not yet. What are you bringing in from the proxy to your own company? I want everybody to get it. That is why I'm going this way. So that you'll be able to explain to
The
somebody
data assets. The beta asset of the proxy company.
Fine. And what is the beta asset of the proxy company? What is the definition of that beta asset? What do you call it? That beta asset is measuring what type of risk?
Financial risk.
Mbanu.
Business risk.
It's measuring business. So you are borrowing the business risk from the business you've not done before. You want to know what is the business risk in that sector. So you are incorporating it into your own structure. That is the essence of getting the first step, asset beta. I want you to understand it so that you'll be able to explain to somebody else. Because most time, even at SFM class, this is an issue. Yes. So, but once you get it this way, you are fine. So that is why I'm taking my time to ask you questions. So as you get it, fine. If you don't get it, it will be a clear mark, and I will respond to those areas. So that's why I'm going this way. So you are bringing in the asset beta, which is the business risk, into your own structure. And that is why you have to ungear to remove the financial elements and get the business elements in order for you to incorporate the business risks into your own structure. So we now regear. When you regear, what are you trying to get? When you regear, what are you trying to get? What is that risk you are trying to get? When you regear.
Financial risk.
From these, this is the regear formula. So when you regear, what are you trying to ascertain?
I think if you regear, you to remove the financial risk.
No.
So remove the business risk and the input financial risk.
No. Look at the
I
meaning.
said the financial risk associated with the new project, that is new company.
Yes. Look at the words. Ungear is to remove financial risk. Regear is to what?
Put it back.
Is to put in back the financial risk.
So this is it.
Which is
I define
debt
equity beta as what? I define equity beta as what the other time? Measure of business and financial risk.
Financial risk.
So this equity beta will show you both the business risk you are bringing in and your own financial risk. That is the regear, these aspects. Regear. So you use this formula. As I've said, there are quite a number of formulas. Yes, but just as you solve one or two questions, know the one that suits you and stick to it. Yes. So you can, as you try to solve and you see different ways, stick to one. Or else somebody can easily get confused and to be an issue. So you regear. So based on this question we are solving, let's still go back to our own company, which is Zedmore. For Zedmore, we need to analyze the financial structure of Zedmore. We need to look at that. We need to analyze the financial structure of Zedmore. So now we need to regear. We need to regear. So now, regear using using what? Zedmore. Regear using Zedmore. Using Zedmore close gearing. So now let's look at Zedmore. What is the market value of equity of Zedmore? We need to analyze that. the market value of equity of ZMOCO. ZMOCO's capital structure is as follows. Equity, we have share capital, in bracket 50 cents per share nominal value. So the market value of equity of ZMOCO will be what?
1.05.
Yes, that is for one share. For the overall share, how many shares do we have in 40 million? Is a question we need to ask. How many shares do you have in 40 million? You know, 40 million is the value of the share you have, monetary value. But in that 40 million, how many shares can you bring out of it?
80 million. 80 million shares.
80 million.
80 million shares.
80 million shares. How do we know?
40 million
40
divided by the
million
nominal
divided by
0.5.
Very good. 40 million divided by 0.5. So that's 80 million. When you multiply it by the value of one share, current value of one share, what will you have? The current value of one share is 1.05.
84,000.
84 million. So please take note of some of these things. So the market value of equity will be what? 40 divided by what? 0.50 multiplied by what? 1.05. And you have what? $84 million. You have 84 million. Now, still in the capital structure, we know we are working based on market value. We don't have business with retained earnings. Now, in terms of the long-term liabilities.
Sorry, Mr. Topel. Sorry. I have to ask a question. So what's your VE now?
You said?
What's your VE? What's VE here?
Market value of equity, which is $84 million.
VE.
Market value of equity of ZMO.
Okay.
Yes, VE is market value of equity. I don't know if that is clear. So now, for the loan notes, we have 6.5 irredeemable loan notes. $100 per loan note nominal value. Nominal value. The value of one is 100. The value of one is 100. So now, based on this, what will be the market value of the loan notes? What will be the market value of the loan notes?
2.5.
The market value?
Oh, no. It's number of shares.
Of the loan notes. The market value of the loan notes.
152.5.
Okay, very good. 162.5. Let me show it. You know, I explained something like this while we're talking about the proxy. In the question, the value of the loan note is what? 250. How many loan notes will you have in 250? You can divide that by what? 100. Multiply by what? One loan note is quoted currently at what? $65.
$65.
Is in the question. $65. And this will give you the market value of debt to be what? 165. Point what? 162 rather, 0.5. 162.5. 162.5. Please press your calculator. Let me know. I'm also pressing my own. So 250 divided this 162.5. Now, let me ask, what is the difference between loans such as bank loan and irredeemable loan notes? Who can give me a difference? Though we're here to talk about all this under working capital, but what is the major distinction between bank loans and irredeemable loan notes, redeemable loan notes? What are the differences? Or just one difference?
Bank loan is a short-term liability,
Okay.
while irredeemable loan is a long-term liability.
Okay, fine. Yes. Yes. It's one of the difference. But regarding these now, one of the difference is that bank loan is not a tradable loan. It's not tradable. Irredeemable is a tradable loan. That is why you can have issue of market value associated with it. So bank loan, for bank loan, the market value of bank loan will still remain what? Will still remain the 20 million because it is not tradable in the market. So you will not have issue of market value associated with it. So the value of that bank loan will still be what? 20 million. Will still be 20 million. You know, there is what we call tradable debt and non-tradable debt. So bank loan is not tradable. I cannot sell my loan to you, my bank loan to you. I cannot trade with it. Yes. So, but irredeemable, redeemable debentures, they are tradable debts. They are tradable debts. And we tend to see more of that as we go in our discussion. So now, the market value of debt will now be what? Of loan note rather, because we have two forms of, okay, let me differentiate it. Market value of debt. This will be loan notes. And market value of debt. Market value of debts. We have bank loan. Or value of debt rather, not market value, since it's not tradable. So the value of bank loan will give us what? 20 million. Still same thing, 20 million. So the question now is, what will be your total value of debt?
$182.5.
Total value of debt.
182.5.
Will be equal to 162.5 plus what? Plus 20. So we have it as what? 182.5. 182.5. Now, with this data, can we now regear with this information? Can we regear with this information? Can we regear?
Yes, sir.
Let's try. Try. What formula are we using? Let's use this.
Sir, is that X or multiplication sign?
It's multiplication.
Okay, sir.
So you have your asset beta computed, right? You have your asset beta computed, and the value is what? The one we compute 0.94. So with all these values, you should be able to solve. Let's substitute into the formula and let's see.
I got 2.98.
Okay, 2.98. Okay. Let's wait for others. .98. Hope we are solving. Hope you are not getting scared of these formulas. They are nothing. Just keep writing them and you get used to them. And some of us are not used to the word beta. We think it's only science students that talk about beta. Yes, I want to get like 5 results. And I'm in NECA.
2.57.
2.57.
Yeah.
2.57.
This is serious. That is very correct. You are correct. I'm just, as somebody have said that my priests have taken over the class.
No.
I recalculate, I got 2.57.
Yes,
Yeah.
2.57.
It's 2.57.
So I got 2.57.
Yes, 2.57. .57. That priest, is it Obuduraj you went for the holiday?
New year program here and there.
So my answer is different. So I got 2.73.
2.73.
Yes, 2.7380.
Okay. Fine. Let's see. So your asset beta is what? 0.94. 0.94. What is your asset beta? 0.94. Your debt value is what? Debt.
185.2.
182.5.
182.5. Then the tax rate is what?
20%.
Everything is 0.6. 1 minus 0.2.
0.2.
0.2.
Divided by what? The equity.
84.
82.
84. So, madam, you that are getting different answers, can you tell us how you are pressing your calculator?
Sorry, sir. Can you
I
help us
multiplied
leave?
182.5 by 0.8. I arrived at 146 divided by 84 then plus 1.
Then do you multiply by 0?
Then 4. Okay. Let's see, I think that's what was it. Okay, I got 2.57 now. Thank
All
you,
right.
sir.
So, Mr. Inusa, you want to say something, sir?
Yes, sir. I'm following you gradually, but I don't know if you can help us leave the formula up before the working down, in case you easily understand where you are inserting the figure from.
All right, sir.
Thank you, sir.
So this is the formula. So having done this, okay, the results will be equal to 2.57. So this is the equity beta, 2.57. So what is the next thing? The next step will be what?
Calculate cost of equity using Kappa.
Okay. Cost of equity. Cost of equity. So from your understanding, how do you think that would be? The cost of equity. Cost of equity. What are we using? What will be the approach, the formula to use based on the information given? Cost of equity. We have to use CAPM, right?
Yes, sir.
If you follow the step, you see it. You have to use CAPM. You have to use CAPM. That is this. You have to use CAPM. So when you do this, from the question, your risk-free rate is what?
4%.
Your risk-free rate is 4%. Your equity beta is what?
2.3.
The one derived 2 point what?
2.57.
2.57. 2.57. And your market return is what? Your market return is what?
10%. 10%.
Your market return is 10%. And your risk-free rates will be what? with 4%. So your cost of equity will now be what?
Nineteen point four.
19.42.
The cost of equity will be equal to what?
19.42.
19.42%. 19.42%. So going by the question is telling us to do what? That using the capital asset pricing model, calculate ZMOCO's current cost of equity and a project specific cost of equity suitable for. So based on this now, have you computed the project cost of equity, specific project cost of equity? Based on this, the answer is yes.
Yes. The one we just completed now.
Yes, the answer is yes.
Cost of equity is
Yes, project specific cost of equity. The answer is yes. So now that is where this question wants us to stop. But because we want to talk about, we want to show WACC, the issue of WACC, I'll take it further. So, you know, after this, determining your cost of equity, you need to determine what? You need to solve for what? You need to solve for what? WACC. You need to solve for WACC. You need to determine, if the question asks you, determine the project specific cost of what? WACC. So you need to go further. So what is the formula for WACC? You know, we emphasized WACC in our last class. To solve for WACC, what do you need? This is it. This is it. This is what you need for WACC. This is what you need for WACC. So to solve for WACC, what are we going to do? To solve for WACC, you use this formula. And based on our computation, what is the cost of equity? What is our own cost of equity?
19.2.
Our own cost of equity is what? We just computed it to KE.
19.4.
19.42.
Okay. 19.4.
19.42%.
19.42%. Our market value of equity is what?
84.
84. Market value of equity, 84. It's just substitution. The market value of debt is what?
182.5.
182.5. So what will now be our cost of debt? What will now be our cost of debt? Our cost of debt will be what? You know, we are not given in the question, right?
I don't know if it's enough.
Our cost of debt will now be what? Cost of debt for irredeemable loan notes. What will be the cost of debt? You need to now refer back to the elementary. Cost of debt will be what? Cost of debt for loan notes. The cost of debt for loan notes will be what? 6.5% of 100 naira will give you what?
Two?
6.5.
162,500. 162,500.
6.5% of 100.
Okay, of
She give you
100.
6.5.
It's 6.5.
6.5.
6.5,
So
yes.
6.5. This 6.5 net of tax. Net of tax. What will that be? 1 minus 0.2.
To be 5.2.
Divide by what? The market value, 65. Remember those early days. So this will give you what?
5.2 divided by 65. Divided by.
So this will give us what?
8%.
Very good.
8%.
8%. 8%. For the bank loan, what will be the cost of the bank loan? The cost of the bank loan will be what?
$20 million.
Cost of bank loan.
It's
On the
1.2. It's 1,400,000. 7% of 20 million.
It will just, this is how you compute it for bank loan. It's just
Divided by 100
7%.
of 20 million.
5.6%.
That would be 1.4.
How did you get that, sir? How did you get that? Somebody that said 5.6%. How did you get that?
Okay, 7%. 7% of 100.
Yes. Is what? 7.
1.4. 1 times 1.08.
Yes. So to get your interest on bank loan, it is simply the interest net of tax. Interest net of tax, which is 7% of what? Of the tax shield. 7% is the interest you're paying. You understand? And the value of a loan, of a debt, is 100. So 7% of 100. 7% of 100 is what?
1.4.
Multiply by what? 0.8. 0.8. You have what? 5.6%. You have 5.6%. You have 5.6%. And it's in my slide. I don't know if I showed that. You see the cost of debt. Do you see it? We treated this before now. So, yes, cost of short-term funds. See it. It is just the interest 1 minus t. The interest into the bracket of 1 minus t. So once you have issues of bank loan, it's just as simple as this. Okay, I'm even having same result, 5.6. So you can see. So when you have short-term funds, this is the treatment. That is the interest, 8% net of tax, and you get the value. So it is 5.6. It is 5.6. So what are we now going to do with this 5.6? What are we going to do with 5.6 and the earlier results we obtained? What are we going to do with them?
Add them together. Add them together.
Okay. Add them together. Okay. Add them together. Before you add them together, there's something you have to do. You need to look for the weight of the two. Yes. We won't just add them together. You need to look, what is the portion of what is it called now? Of bank notes on the overall debt. Now, the overall debt is what? As in, you need to look for the weight, of both. For the weight of both. For the weight of both. And how do you look for the weight of both? The weight of both now. How do we look for the weight of both? The total debt is what?
Okay.
Total debt is what? 182.5, right?
Yes.
182 in terms of the value, market value. 182. Let me show it. So what is the percentage of loan note in 182? Let me show it. There is a question like this also, whereby you have two issues. You have, I think we treated that last night. It's also part of the question I have here. But in another form. I'm bringing it in another form. This question is a question whereby it's you have two issues. So you don't just treat it like that. You need to look for the weight also. This is also a question similar to a question I treated last night, but with a different touch somehow. So, but for this solution, all right. Okay. So this is the cost of debt. The cost of debt for bank loan. So what are we going to do? How are we going to get a common cost of debt for both? We need to look for the weight. Now, loan notes. The weight of loan notes will be what?
162.5 over 185.
Yes, 162.5 divided by what? 185, 182.5. I'm not mistaken. Yes. And this will give you what?
89%.
0.89. 0.89. And for bank loan, it will be what?
20 over
182.5. The result will be what? 0.11. So if you add both, you have 1. Understand? Yes, so the cost of debt will now be what? Will now be 0.89 multiplied by what? Multiplied by 8% plus what? Plus 0.11 multiplied by what? 5.6. Okay, this is This is 5.6 here. Multiply by 5.6%. So when you solve this, what are we going to have? Our cost of debt will now be what? If the question have given it to us directly, we don't need all this. Yes, but the question is not designed to compute WACC. So it stopped at that point. So I decided to take it further. So your cost of debt will be what? Once you compute this, should be 7.12% at this point. This will be plus what? Should be 5.6. We have 0.62%. So when you add both together, the result will be what? 7.74. In most questions, you always be given, you can see, somebody will be frowning at this. This one is a special one again. So your cost of debt should be 7.74. So we don't need all these net of tax. We already solved for tax issue. Somebody asked me a question like that. That once you've solved for tax issue before, you don't need to recompute again. So our cost of debt is simply 7.74. Our debt value is what? Will still be what? 84. At this point, this will also be what? 84. 84 plus what? 182.5. So this is WACC. When you treat this, you have your WACC. So can I get the result, please? Okay, sorry. This should be debt up here. Somebody is not following me. Hello, can you hear me, please?
Yes.
So
Yes, sir.
when you compute, please, what will be your WACC? What will be our WACC?
Yeah.
The WACC will be between your cost of equity and your cost of debt. Anytime you solve question on WACC, your result will definitely be between 9.42 and 7.74. It will be between those two values. Hope you are pressing your calculator. I'm not getting sound of them. So our project specific work will be what? I want to know if it's 84 plus 182.5. 182.5. 266.5. 84 divided by 266.5. Multiply by what? Multiply by 19.42. I have 6.12. Okay, that is on one side, 6.12%. For this, okay, So
percent.
182.5. What do you get, sir?
11%. 11.4.
11%. 11.4. All right. I think that should be the result. So 11.4. So
11.4.
all right, 11.4. So ZMO's project specific cost of capital.
So you were trying to put 11.4 up.
Okay. All right. Yes, I'll put it. 11.4. WACC will be equal to 11.4%. So ZMO's project specific cost of capital, or specific, no, not specific cost of capital, no. ZMO's project specific WACC. This is WACC. Take notes. ZMO's project specific WACC will be equal to what? 11.4%. So you must have an understanding that there is a difference between cost of capital taking it further, I discovered some exposition likewise. So when you have two forms of loan notes and your cost of debt is not categorically given to you in the question, you adopt this approach. So these has enlightened us the more. So if you look at that question I forwarded, there are some other theoretical issues likewise in the question. As I've said, in the present day ICANN, to me, we should always be prepared for both theory and the calculation parts. It's very important. Yes, sometimes the theoretical part can boost your pass rate, But by the time you gear and ungear and do everything, and you don't know some simple literatures you need to put down, it can cost you a lot. And that is why you must not overlook the theory aspect as you study. You must know reasons behind everything we are doing. So based on the question, can somebody read the theory aspects of the question? Theory aspect of the question. That is, I think after A1, there is A2. The question said comments, right? Comments. Very fast. Some people might have class now, so that I don't. The question says comments. Can somebody read?
Okay. Referring to your calculations above, comment briefly on the
Yes.
view of the commercial directors.
On the view of the financial director.
Commercial directors.
Commercial directors. Okay. Okay. So based on your own judgment, what can you say? Why is the project specific cost of equity higher than the current cost of equity? If you want to compare both results, you know, at the beginning we computed the current, then we now computed project specific. So if you are to comment, what is your observation? You know, the project specific cost of equity, we have 19.42%, while the current we have 17.8%. So what can be your comment? Yes, beyond this computation, you must be able to interpret. Any trial? All right. Because of time, I would say that the project-specific costs of equity is higher than the current cost of equity. And what these results indicate is that a higher return will be what needed by shareholders to compensate for what? For the higher risk of the new business, of the new venture. Yes. So once we are getting a return less than 19.42, it means the shareholders will not be happy. So there is more risk associated with the new venture. Reason why we are having more higher cost of equity, because we incorporate the business risks of the WDC, if I'm not mistaken, into ZMO, and it results into higher cost of equity. So appraising the venture using the existing cost of equity as advised by the commercial director will therefore result in an overstatement of the venture's net present value. And if we do that, we'll be making a great mistake, because based on the new venture that we venture into, there will be more risk associated. So going by the current value will be misleading, and that will not be fine. That will not be fine. So this is a little comment I can give to that. The B part says what? Can you quickly read, sir? The B part. I don't have the.
Discuss three problems.
Right.
Discuss three problems Zedmoco may be facing as a result of its current high level of gearing.
Yes. So what are the problems associated with high level of gearing? We should be able to speak to this. Some of us are financial managers. Yes, very fast. What are some of the problems associated with high gearing? So you must just reflect. When you have too much debt, what are some of the problems that you can experience? Yes.
Can lead to winding up the company.
Very good. Bankruptcy problem can result. Bankruptcy. When you live on debt too much, can result into bankruptcy. What other thing can we think of?
Ordinary shareholders won't be able to get maximum returns on their investments.
Very fine. Very fine. So there will be increased volatility of earnings. Increased volatility of earnings will increase the cost of equity. Yes, because the more the risk, the more the shareholders will want more returns, and that will result into problem. Yes, somebody wants to say something. All right. So there are quite a number of other issues of debt capacity. That is the gearing level might affect Zedmo's company's ability to raise new debt finance. Yes, because before you are being given a facility, you must provide certain documents. The might affect Zedmo's ability to raise new debt finance and how much debt it can support. So all these are issues that might result. So once you're faced with such questions, just think around and see that you write. Don't just leave your answer. Especially question one will always consist of issues like this. You have calculation, you have theoretical aspects to write to buttress your computation. So, any question as regards to this? Please, I encourage you to solve this question again. Yes, solve it again. Yes, again and again until you have maximum understanding of what the question is. Sometimes in class, you might not get it as expected. So the assignment is go back and study it again. It's very important, very, very important. Yes, sir. I'm with you, sir.
Thank you, sir. Please, can you help us drop it immediately so that we'll go through it? Most especially me, that I missed the foundation,
Yes,
sir.
it will take some hours before it drops. It is being generated automatically from the Meets, from Google Meets. I don't have access to the video now. So maybe by 11 p.m. it should drop in my mail and I will share on the
Okay, sir.
platform. So the longer the class, the longer it takes for it to process.
Is it different?
So that is how it works.
338. This is
So
168, Abi.
so
376. Abi. Plus 100,000. Abi.
so